Our headliner today says to look beyond tech for some of the best opportunities in 2025. Malcolm Etheridge is the managing partner at Capital Area Planning and a CNBC contributor. Malcolm, good to see you. Happy New Year.
Happy New Year. Good to see you, man.
All right, so where are we looking at beyond tech for opportunities as we go into the new year?
Yeah, so I don't know that I can call it completely beyond tech because it's going to end with the word tech, but we're looking at fintech as one of the places that investors should be considering in addition to fintech, the broader financial sector.
All right, so is fintech an area you like because you think there'll be less profit-taking going into the new year? We've seen broader profit-taking as we close out the year. Some thoughts that it might actually continue as we go into 2025 as well.
Yeah, no, I actually think that profit taking is going to continue in the bigger names, the mega cap names, the Mag 7, whatever we want to classify it as. And it's especially among retail investors, right? If you look at a name like Tesla, 40% owned by retail, Nvidia, 30% owned by retail, those dollars are going to have to go somewhere. And more than likely, those dollars are going to be part of the broadening story you guys started off the segment with, right? So where you look for opportunities among, as investors, as you look for opportunities, you're looking at some of the most hotly anticipated IPOs of next year, for example, all in fintech, Klarna, Stripe, Chime. Those are the kinds of names that I see those dollars flowing to as investors continue to take profits and raise cash to look for what's coming next.
All right, so you're looking at fintech. You're also looking at the money center banks. You're seeing opportunities there. Are there any particular names, or are you playing the sector more broadly?
Well, the IPOs that I just mentioned, right, all of those names are already in talks to be brought public by JP Morgan Chase, Morgan Stanley, Goldman Sachs. It's the usual players. And so I think that those GSIBs, the money center banks, the big banks, the too big to fail banks, however you want to classify them, those are the banks that will benefit in any environment next year. So we talk deregulation, that's going to benefit them. We talk about falling interest rates, that could benefit them. We talk about M&A activity, whether it's IPOs or traditional mergers and acquisitions. That's going to benefit them. So it's a heads they win, tails they win kind of scenario. And so I would want to look to play that using something like the XLF instead of maybe the KBE that's more broad-based, specifically because you want to get exposure to the larger names and leave the smaller community and regional banks alone.
Malcolm, I also want to talk to you about cybersecurity. Now, you have an interesting thesis when it comes to cyber. You also have a pick for us. What's your favorite name when it comes to the cyberspace?
Yeah, so I actually like the index CIBR, the cybersecurity index that owns both Palo Alto and CrowdStrike, because I know those are the two more popular names in that space. And if we talk about platformization, those are the two names that have gotten there ahead of everybody else in the sector. But I think that cybersecurity in 2025 is ripe for mass consolidation. I think that there's a lot of names, the smaller cap, micro cap names that are going to end up getting bought up by a lot of the other names that are looking to become platform players. And we don't want to necessarily have to choose the best 1, 2, or 3 that are going to sit up next to CrowdStrike and Palo Alto. And so I think the safer play there is to go for the index approach.
All right, Malcolm Etheridge from Capital Area Planning. Great to see you. Happy New Year. Thank you very much. Jenny, I want to come over to you about cybersecurity. You actually sold out of Palo Alto Networks, one of the companies that he was talking about.
Right. So here's the problem with cyber for us, and it's the most compelling story. We know that we're going to need it forever and ever. But the problem is they are actually kind of mature companies. So when you look at CrowdStrike, it trades at like 350 times. Fortinet and Palo Alto both trade at 45, 50 times earnings. And when you look at their earnings growth, it's reasonable. It's like mid-teen, not even mid-teens, maybe like 10%, 12% as you look ahead. So the problem is, as with so much out there, the story has pumped up the share price in an unhealthy way. So do I want to get back into the space? Absolutely. Do I want to get back into it when the shares have reached a reasonable valuation where the earnings growth that's there can actually justify the valuation? Yes, I want to be there. We'd bought Palo Alto several years ago. I think when we bought it, it was like a 10% free cash flow yield. We had this huge, like 600% return on it when we sold it. I want to be in at that point. I don't want to be in at this point. And so there's so much of this. To me, they're the poster child for what's wrong in the market right now, which is that the stories are fabulous. People pile in with no heed to valuation, and it blocks people out.
But Jenny, I do have to say, if you see strong earnings growth, doesn't that more than likely mean there was a big cyber incident that's leading more money to pile in, and you're going to see the same cycle repeat and repeat?
They're mature. Like, you look at their earnings growth, and they're like 12%. I don't want to own something with a 12% earnings growth that's trading at 50 times. It's like American Express. I'd rather own American Express with a 22 times multiple with the same earnings, same or better earnings growth. Right. It's just too expensive.
All right, Palo Alto trading lower right now.